Let's talk about the Fed. Everyone has been anticipating the Fed's decision for rates. And we ended up getting what we thought we would get. You know what I mean? Like we really thought that it was basically priced in 25 basis points. You might be saying to yourself, well, then why did we fall? Why did we drop if it was all priced in? And why the hell were you buying SPY calls on the way down, Stocky? Oftentimes we get initial reactions when it comes to Fed decisions, all right? But let's start from the beginning. Some of you guys don't know how Fed rates affect the market and the world. The Federal Reserve, all right, is in charge of monetary policy. Don't get this confused with fiscal policy. That is your congressional duty, okay? Fiscal policy is how money is split up and spent and done, everything like that. Monetary policy is the value of money, the amount of money, controlling inflation and rates and everything like that, okay? What does a rate do? Well, this is basically how much it costs banks and other big entities to borrow money from each other, right? Sometimes a bank has extra cash on hand and another bank wants to make an investment or a move or needs cash for something, so they borrow cash from each other. And because the Fed is the central bank, they basically dictate how much it costs to borrow money. So the cheaper the money, and the Fed does this with reverse repos all the time. You can borrow, but because it's a central bank, you know how much you can borrow from the Fed as well, rather than other banks. Overnight, and you've heard of sweeps, guys, right? Like overnight cash sweeps and stuff like that. That's what they do. They take your money that's in your bank account and they invest it. And that's why a lot of times you can't even take out a certain amount of money at a certain amount of time without authorization because they're putting your money to work. But maybe there's an opportunity that comes along and they want to throw their money at something, or they want to, there's a million reasons why they could do it. They could cover a position in the market. They could cover a position in mortgages, anything. So what they do is they borrow money, and the Fed gives them a rate of what they borrow money at, which then trickles down to how much more it costs to borrow from the banks. Right? So if the Fed rate is 0%, okay, and they're just transferring money and they're lending money to you for a mortgage or for a car or, along those lines, it's going to be cheaper, right? Because it's a trickle down effect. So what that does is, as we've talked about before, that drives economic growth. People take out home loans, right? Mortgages. They take out business loans. They take out personal loans. They buy houses. They buy cars, credit cards, et cetera, et cetera, et cetera. And that's supposed to grow the economy. But this is only supposed to be I know it's not exactly, guys. Okay, I'm only going to say this once. I'm going to stop reading chat. For those of you guys in here with fucking finance degrees and all the other shit, this is a very watered down version for people who have no idea what I'm talking about. There's a lot of intricacies and a lot of specifics I'm going to leave out of this. Stop acting like you're better than everybody, okay? I'm talking to everyone in a general sense. Thank you. Now that we have that out of the way, interest rates, it takes time, but it trickles down. It affects everyone. It's about borrowing, right? How much money costs to borrow, all right? How much money costs to borrow, whether it's bank to bank, bank to Fed, whether it's government, whether it's people, that's how much it is. So when you are having economic problems, you're having a slowdown in the economy, whether it's through, through a pandemic or through a war or whatever, GDP is coming to a slow. You need to kickstart the economy. You need to kickstart buying. How do you get buying going? You lend money cheap. It encourages people to buy. Look what happened with the housing market, right? We're in the middle of a pandemic and a stock market pullback and the economic, the housing went crazy, right? Because everybody could afford to refinance or go out and finally buy houses, which in turn ended up driving the price of housing up, okay? But it brought economies, it brought jobs, people building houses, real estate agents, lenders, there's a lot of things, right? And then it also brought tax revenue and a lot of other things. The problem, though, is that if you keep rates too low for too long and money is too cheap and there's too much spending, you start getting inflation. There's a very fine line between where there's a line here, and you want to get us right around here, right? And then you want to pull the rates back up. You're like, all right, I'm opening up the floodgates and I'm letting it fill up the tank, and I want to close it before it overfills. The problem is that this wasn't a normal situation. COVID, right? And then you had supply chains, and you have war. There's a lot of things. So the Fed kept pushing off raising the rates. The whole time, the Fed was also lending money to the U.S. government because the government had to borrow money. How else were they going to pay for everything when people are out of work and not paying taxes, and you've got to also give people stimulus checks and you've got to pay for things? They were borrowing money from the Federal Reserve. And it was basically a swap, right? Like a swap or an IOU. The Fed basically said, hey, we're going to take your treasuries and we're going to hold those as collateral to give you money. The problem is that they went from $6 trillion to $9 trillion on their balance sheet. So in other words, the Fed is holding $9 trillion worth of other people's debt. That's a lot of money to hold. So there's a couple things now that you know that we're going to get to yesterday. Yesterday, the Fed announced that they were giving the first rate increase at 25 basis points or 0.25%. That's what the consensus was. The market had priced that in. But the problem is that because it was what it was priced in at, markets started selling off because the concerns right now are a recession. There's a lot of concerns about a recession right now. Several factors. Oil's high. Not every recession has been caused by oil, okay? Not every recession was preceded by the spike in oil prices, but every spike in oil prices was succeeded by a recession. Coincidence or part of the factor? We'll see. The 2-10 curve is flattening. This is your 2-year yield and your 10-year yield. Your 2-year, your 10-year, and your 2-year should look like this. It should not look like this. So the yield curve is inverting. We have war. There's a lot of things going on. So there's a lot of concern about a recession. We don't have war. There's war in the world right now that's fucking up supply chains and fucking up commodity prices, which is skyrocketing. Inflation is also a part of this factor too. Inflation is going up significantly higher than anticipated. All right, so 25 basis points. Then they announced that they're also going to potentially, at least now is the plan, do a rate hike 6 times. After every single Fed meeting this year, they're going to raise it up, okay? And the reason they're doing this is they want to pump the brakes, okay? Because when you start getting inflation running out of control, you have to raise rates. You have to make it, you have to stop, you have to stop the inflation. You have to stop the amount of money out there. But you can't just pull the brakes. Think of it like a car, right? A car driving 100 miles an hour, and it's coming up on the back of a parked truck. Well, you can't just keep going, or you're going to slam into the truck, and you're going to, a big fiery, it's death. But you can't immediately hit the emergency brake because then everybody goes flying out the window. So what do? You have to pump the brakes. And that's what they're trying to do here, is pump the brakes, okay, to kind of get it stopped at a slow pace. The problem is we're going to find out if they waited too long to start pumping the brakes. See what I mean there? How does this affect with the dot plot? And this is why the market bounced up. So the market fell initially because they're like 25 basis points is priced in, and these small little increments are leading us up. But you know what? It might not be enough. So why did we start going back up when Powell talked? Well, Powell brought up a couple things. Number one, he tried to ease concerns of a recession. They also came up with a bunch of full of shit when they said, hey, we were wrong about our projections on inflation 2 years ago, but we're going to be right this time, and we're expecting inflation to slow down in the end of this year. But here's the dot plot, and here's my problem with the dot plot. But this is what they're looking at. So your dot plot, ladies and gentlemen, is a plot where they take years, they take several years, and they get all of the federal. Oh, by the way, the vote was 8-1 with our friend Bullard asking for 0.5%. And what they do is they get everybody on the board to give where they believe interest rates for target of where they think it should be at a given time and compare it to the dot plot for inflation expectations. So the dot plot that came out yesterday, this is where they were at 1.5%, 2, 2.5, 3, 3.5, okay? That's kind of where the rate dot plot was, okay? And this is what the dot plot looked like for 2022. You know who that was up there. These are the projections for 2022. That means by the end of this year, this is what they were expecting or wanting to happen. So it looks like the consensus was about 1.75. So that kind of prices in and lets everybody know what the Fed is thinking, right? That's what the dot plot is so important. There's other dot plots that come into factor the inflation. However, 2023, your median was at 2.75. Okay, your median here was at or 1.8. And this is why the market actually went up a little bit. Because the dovish initial report when it fell was inflation's going to go wild, right? But then once the dot plot was released and then Powell got up and said, we're going to be aggressive if we need to be, we can change it. There's a lot of factors going on with resurgence of COVID and the Ukraine war, but this is where we're at. So that means that they're actually going to put on the brakes. It's just, can they get here or not? This will tighten the monetary, outflow. 2024 was a little bit more out of place, but basically the median was at the same. But then longer term, it was almost completely in consensus from 2025 and beyond. Consensus was almost completely at 2.25% average, which is in line. My only concern is that if we only get to 1.75 by the end of this year, will we be too far gone on inflation if we don't get the supply chains and we don't get, full employment happening? At this rate, MBA, they're expecting 4.5 to 4.7% as the average mortgage rate at the end of the year. Aren't we near full employment already? Full employment for people actively seeking work, but people that are retired early or people that walked away and haven't looked for, remember, unemployment is only counted for people actively looking for work. You don't get 4 million plus people every month for a year walking away from their jobs and be full employment. There's 11.7 million open jobs right now. Aren't we at 4.5 mortgage rate right now? We are close to it right now, and that's why because it was pricing in exactly what happened. It priced in exactly what happened. So they're not expecting it to cool off at the end of the year or go up anymore. So after that, he also said that inflation was higher than expected, but they are expecting it to cool down. And also that the rates can change, but they are expected to have 6, and that's the dot plot. Bullard was the only one that wanted to go more aggressive right here. My concern is that it may, I almost feel like we needed that 0.5 to just kind of pull it and then go from there and kind of let the market take a step back and then kind of build from there. But it's funny because they went dovish and hawkish at the same time. You understand what I mean? My favorite thing, though, was that they are going to start clearing their balance sheet. They didn't really give us an understanding of exactly how much and how much time, but yeah, they're going to start clearing that balance sheet, which is super important. Why'd the market go up though? Because once Powell started talking and he started focusing on we're expecting inflation to go down. We are not expecting a recession. Also, we're gonna keep money flowing. We're not going to clear our balance sheets quite yet. We're not going to stop it. They don't call it QE anymore, but they're basically going to keep, putting money in and not tightening yet, not clearing yet, despite the rate increases going up. Like they're going to clear it, but they're not doing it yet. They want to keep it until they get full, everything ready to go. And so everybody's like, okay, they're going to cut rates or they're going to raise rates to kind of get inflation under control. They're going to keep putting money in until we're stable, and they're not expecting a recession. All right, fuck it, let's go. Also, the European Central Bank just rose interest rates for the third time, guys, to 75 basis points.